Okay, so in today's session, we are going to look at the conceptual framework in accounting. So in accounting, as we record transactions, there are rules that we're going to be using as we record the transactions. But have you ever wondered where these rules are coming from? So the conceptual framework, this is our rules book in accounting. This is where the rules that we use in accounting are derived from. So in the conceptual framework, there are different areas of the conceptual framework that we need to discuss about today. So let's start with the conceptual framework. So the conceptual framework, that's our rules book in accounting. This tells us the rules that you're supposed to follow when recording transactions. So the first thing that we need to talk about in the conceptual framework are the definition of key terms. So the conceptual framework gives us the definition of the key terms that we need to be aware of in accounting. So it provides us with the definitions of key terms. So let's start with the definition number one of an asset. So this is a common definition that we meet regularly, especially in the accounting field, an asset. So an asset, according to the conceptual framework, an asset isn't necessarily what we own. Because a lot of people believe or think that an asset is what you own. No, an asset is a present economic resource. Controlled by the business. As a result of its past activities. In which future economic benefits are expected. Are expected to flow to the entity. What are the key takeoffs from this definition? So number one, if something is being regarded as an asset, it's not what is owned, but an asset is what is controlled by the business. So if it is an asset, it is something we are in control of. So if you give me your building to use, I don't stop recording it as part of my assets because I'm not the owner. So I still record the building under my PPE because I'm the one who is using it to get economic benefits. I'm the one in control of it. So the one who records an asset isn't necessarily the owner, but the one who records an asset is the one that is in control. An asset is a resource controlled by, not owned by. So remove that from your mind that an asset is what I own. Anything you're controlling to give you economic benefits, then it can qualify to be regarded as an asset. So an asset is a resource you are in control of. And it's not just you having control that makes it an asset. It is also an asset because you are expecting future economic benefits. So if you are defining an asset, it's important to take into account it's something we are in control of that is capable of bringing us future economic benefits. What about if I control it, but it doesn't give me benefits? It ceases to become an asset. An asset is an asset because we are expecting to derive benefits from it. So from the day it ceases to bring benefits, then we de-recognize the asset. We record something as an asset because we are expecting that one day it is going to bring benefits in the future. So an asset is a resource, an economic resource that we are in control of as a result of what we did in the past. It could be we bought it in the past. It could be we hired it in the past, but we're expecting that it will generate economic benefits. Then besides the asset, number two, we need to know about a liability. So since an asset is a resource which is going to give us future economic benefits, what then is a liability? So a liability is a present obligation of the business arising from its past activity, which will result in the future outflow of economic benefits. Unlike an asset, a liability is an obligation. So if it's a liability, it's an obligation for the business to pay. So we have done something that is given us as a business a position where we are required to be paid. It is now given rise to an obligation for the business. And that obligation is to transfer economic benefits. So it will result in an outflow of benefits. So if it is a liability, it will result in the business losing economic benefits. It could be we are paying money. It could be we are transferring resources out of the business. But if it's a liability, it will result in an outflow of our economic benefits. If it is a liability, it will result in an outflow of our economic benefits. Now, let's move on. Besides a liability, number three, we also need to know the definition of an income. So in the business, we are going to have incomes and we are going to have expenses. What can we say is an income? So an income in the business, an income is the increase in the value of an asset, increase in the value of an asset, or decrease in the value of a liability, which will result in an increase in equity. Which will result in an increase in equity. So the equity of the business, that is the capital, it increases if we make an income. If the assets are gaining value, it tends to increase the equity. We call that income. So when you make income, the assets are gaining in value. Or it could be your liabilities are losing value. So what you are supposed to pay, if there is a reduction in the amount you are supposed to pay, you regard that as an income. So remember the equation, the accounting equation says that assets or let's say equity. We're going to talk about equity in a moment. It says that equity is equals to assets minus liabilities. So having this equation in mind, it means that if assets are to increase or liabilities are to decrease, the resultant effect is that equity will increase. If we increase assets or reduce liability, equity will increase. So reducing the liability or increasing the assets, that is income. So income is when the assets gain in value or liabilities lose in value. And the resultant effect is that the equity is going to increase. So the income can be examples of income. We can have a decrease in provisions. Provisions are liabilities. If they decrease, if the provision is to decrease, is regarded as an income in the business. Then we have the expenses. The opposite of incomes, we have expenses. If the business is to incur an expense, what does that mean? An expense, it is the increase. An expense, it is the increase in the value of a liability now. An expense is the increase in the value of a liability, or the decrease is now the opposite. Decrease in the value of an asset. Decrease in the value of an asset. So if it's now an expense, it means the liabilities are gaining in terms of value and the assets are reducing, which in turn reduces capital, which reduces equity. So if we incur expenses, they tend to reduce the equity. So if the business says we've made expenses, it could mean the assets have reduced the value, or it could mean the liabilities are gaining in value. So let's think of depreciation, for example. Depreciation is an expense. This arises when the asset has lost value. So depreciation is an expense. It's because the asset is losing value. So the loss in value. Or we can talk about maybe rent. Rent is an expense. It's what we have to pay. It's a liability that is increasing. So if what we are supposed to pay is gaining or accumulating, that's an expense. So if the liability is gaining, it's an expense. Then lastly, we have equity. This is the residue income. After the liabilities have been met. It can also be called the equity is the net assets figure. So the equity of the business, we are looking at if we are to pay all those that we are owing as a business, what do we remain with? The equity is what we remain with in the business after meeting the liabilities, after paying off all those you're owing. So if the business today is to pay off all those it is owing, what is it going to remain with? What is the residue interest? So the equity, it can be calculated using the formula assets minus liabilities. Assets minus liabilities. So if the business is making more profits, the equity increases. If our assets are gaining value, the equity increases. But if the liabilities are gaining, it means if we pay them, it reduces what we remain with. So if if assets are high, equity is high. But if liabilities are increasing, it reduces equity. So equity, in other words, is what remains for the shareholders after they've paid all those that they are owing. What do they remain with? That's the equity. What is left for them after they've paid all those that they are owing? Now, let's move on from the key definitions. Please take note of the definitions above. Take note of the definitions above. So the conceptual framework, it tells us the purpose of financial accounting. So the reason why we report the financial transactions is for the users who are the various stakeholders. It could be, we have the users of accounting information. Let's just list them. So we report for the benefit of the users of accounting information. Who are the users of the accounting information? We have the shareholders. They are going to make decisions based on the information we have prepared. They will make decisions whether to invest more in the company or to pull out the investment. We have also, besides the shareholders, we also have, so besides the shareholders, we also have the investors, the potential investors. So the shareholders are those that have already put their money in the business. Then we have the potential investors, those that are likely to put their money in the business. They also want to assess the financial position of the business before they can put their money in the company. We have even the managers, the internal stakeholders. The managers, they want to see how good they are performing. We have the employees, they also want to see how the company is performing. Is there a possibility that the company is going to expand and they get more pay? So they are also going to be happy if their company is doing well, they'll be motivated. But if the company is making a loss, it might be a demotivator for them. So they might be interested in checking the financial position of the business. We also have we have lenders, we have the bank, we have the bank wants to see our ability to pay, even the creditors. They want to see our position. Can they give us goods on credit? Are we going to be able to pay? So the conceptual framework then is saying, these are the users. There are a number of users of the accounting information. So when you are reporting the information, it must be good information. So for these users to be able to make good decisions out of the information you have provided to them, it must be good information. Then, what is the definition of good information? So it must be good information, yes, but what makes up good information? So for the information to be regarded as good information, there are characteristics that the information must possess. So which are these characteristics? So the characteristics are grouped into two. According to the conceptual framework, we have the enhancing characteristics. We have the enhancing characteristics, enhancing qualitative characteristics. Enhancing qualitative characteristics. And also we have the fundamental qualitative characteristics of good information. So we have the enhancing qualitative characteristics and we have the fundamental qualitative characteristics. So on the enhancing qualitative characteristics, let's start with the fundamental. So these are the basics. So information that we are reporting, it must have the fundamental, the basic characteristic. So for it to be good information, for these users to be able to make good decisions out of it, it must have these fundamental characteristics. Which are these? The first fundamental qualitative characteristic, we can talk about information that we regard to be good information, it must be relevant. Being relevant, it means it's fit for its intended purpose. So relevance means you are not including everything, but you are including that which is key, that which the users want to know. There is no need of telling us what the employees were eating at work. That's not relevant to the user. Mainly the user is concerned about the profit position of the business, is concerned about the liquidity of the business, is concerned about the gearing position of the business. That's what's relevant if we are reporting the performance. So relevance, it means the information must be able to assist the decision makers to make the decision. They should be able to make the right decisions using that information. It should suit their needs. It should suit their needs. Then let's move on. The other characteristic, the fundamental characteristic, is faithful representation. We have faithful representation. For faithful representation, we are saying that when we are presenting the financial information, let it portray exactly what took place. Let it show the true picture of what happened in the business. Let it not window dress the accounts. We should not be told that the company is making profits while it's not. We shouldn't be fooled to think that this company is doing well while it's not. As an accountant, you are supposed to have the public interest. You are supposed to put the interest of the public at heart. You are not supposed to be reporting false information. You are supposed to tell people exactly what happened. So faithful representation, the information must not be window dressed. Let it show the true picture of what happened. Let it show the true picture of what happened in the business. Not portray a false picture, not portraying the picture that the company is doing well, while it is not. Okay, then from there, we also have the enhancing qualitative characteristics. So the enhancing qualitative characteristics, these ones, let's have the enhancing qualitative characteristics. So we have the fundamental and the enhancing. Enhancing qualitative characteristics. Let's first of all list the enhancing qualitative characteristics, then we discuss them. So under the enhancing qualitative characteristics, we have verifiability. We have verifiability, we have timeliness, we have understandability, we have understandability. Then the last one should be, what's the last one? It's comparability. So if it's good information, let it possess these characteristics. Let it possess these characteristics. So what do these characteristics entail? So verifiability, we are saying if it's good information, let us have a source. Let us have a source of this information. Do we have the source document to show that this transaction occurred? So do we have a source to prove that it did okay? Is it verifiable? Is it a transaction that we can trace? So everything we include, let it have a source document. Is there a source? There must be a source to prove it's okay. There must be a source to prove its occurrence. If information that I've reported is good, it must be reported at the right time. There is no point of me telling you the performance of the business next year when we are in this year. Let us know what has to be reported this year. Let it be reported this year. So, of course, yes, you report after the year end. So let it be reported at the right time. You can't tell me something that happened 3 years back. No, let it be reported at the right time. If it's good information, let it be relayed at the right time. There is no need of me telling you the answers after the exam. I should tell you before the exams at the right time. The information must be reported at the right time. Information, which is in this particular case, the accounting information, must be reported at the right time. The accounting information must be reported at the right time. Then, besides understandability, besides timeliness, we have understandability. Understandability, we are saying, to the targeted group, let's present this information in a manner that they will be able to understand. Not everyone, of course, when you present the information, there are those we are targeting. There is the target group. The information must be in an understandable form to the targeted group. So the information must be understandable to the target group. So someone with basic knowledge, someone who has the knowledge required to understand. Let's say if it's a director's report, then it should be in an understandable form to the shareholders. So what we report, we need to consider, do the stakeholder understand this type of information? It must be comparable. Comparability means, are we able to assess the performance and tell whether we're now doing badly or we're actually doing better? So comparability looks at its ability to tell whether we are doing better or not. We are doing better or worse as compared to another period. So normally comparability, it goes along with using the same formats, the same methods, so that we are able to tell, are we doing better as compared to a prior period, as compared to a competitor? So comparability is a matter of, are we doing better? Are we doing better? Then the conceptual framework also tells us the financial statements that the entity is supposed to report. So it tells us the financial statements which the entity is supposed to report. So we can say the final accounts. So the entity must prepare the final accounts at the end of the period. So the final accounts of the entity consists of, we have the income statement. The income statement, I'm sure we know this. This one tells us whether the business has been making a profit or the business has been making a loss. So it tells us the final accounts. It tells us the final accounts, the income statement. Then we have the statement of financial position. The statement of financial position, you can call it the balance sheet. We have the cash flow statement. So the statement of financial position tells us the assets and liabilities of the business. So it's a summary that is telling us the assets and liabilities we have at the end of the period. The income statement, on the other hand, is telling us the revenues and expenses which we made during the period. Then the cash flow statement is tracing the movement of cash. During the period, we received this much and we paid this much. Where did the money go? Where did it come from? So it tends to trace the movement of cash during the period. It tends to trace the movement of cash during the period. Then we also have the accounting concepts. So the accounting concepts, these are the rules that assist us or that we are supposed to follow when recording these transactions. The accounting concepts, these are the rules to be followed. So I will go through some of them. So the first one, let's talk about the prudence concept. So the prudence concept, it requires us to exercise caution when recording transactions under uncertainty. So if you are not sure whether you are going to make a profit, don't recognize a profit. So if you're not sure, don't overstate your profits. So the prudence concept says under conditions of uncertainty, do not overstate profit. So under conditions of uncertainty, the business must not overstate its profits. So under conditions of uncertainty, the business must not overstate its profits. So you record profits provided you are sure you are going to make the profit. This tends to apply more to the income statement. So besides the prudence concept, we also have the matching concept. Which requires us to match the revenues for the period with the expenditure for that particular period. The business must match the revenue for the period against the expenditure for that period. We should match the revenues against the expenses for that period. So if we incur expenses, we record them in the period in which, if we incur expenses, these are recorded in the period in which they are incurred, not in the period in which they are paid for. So we recognize them. The same period, we are recognizing the revenues. So we recognize them the same period. We match them with their revenues. Then we have the going concern principle. We have the going concern principle. So the going concern principle requires us to recognize the business as a going concern. So transactions must be recorded with the view that the business will continue to operate. The business will continue to operate for the foreseeable future. So when you're recording these transactions, we must have the view that the business will continue to operate for the foreseeable future. There are quite a lot of them. We'll just list some. Then some of them will be talking about them as we proceed with the syllabus. So with the going concern concept, we also have the consistency principle. So the consistency principle requires that when we are recording transactions, let's be consistent. Let's use the same methods. Let's use the same formulas. Let's not be changing each and every time. So the business must adopt the same methods that it is going to use for this. Let's call it the same method or policy that it will apply to similar transactions. So we should adopt the same way. We should not be changing each and every time. So we should adopt one particular way we are going to be using. Then we can look at other principles such as the dual entity principle. The dual entity principle says for every transaction, we must record in 2 books. So in accounting, for every transaction, there are 2 accounts affected. So if you are recording transactions, for every transaction, you must record in 2 accounting books. So 2 accounts must be affected. Then, besides that, we can also talk about the business entity concept. So the business entity concept, this regards the business as a separate legal entity. It means the owner is separate from the business. They can't just take anything out of the business at any time or introduce anything at any time. Once they take something for personal use from the business, we regard that as drawings. Then if they add, then that is up to, that also contributes to their capital. So the business is separate from the owner. The business is separate from the owner. So if they take their personal funds and put it in the business, that's capital. They take something from the business for personal use, those are drawings. Maybe let's just add one more. Substance over form. We consider the legal, the economic substance. Not just the legal substance. I'm just summarizing this. Not just the legal substance. So if we are saying we recognize the economic substance, not just the legal substance, this goes together with the definition of an asset, where we were saying we recognize an asset because you are the one benefiting from it. You are the one getting the economic substance. So even though legally it's not yours, like if you are on hire purchase, you are using someone's property, you are not yet done paying for it, but because you're the one getting the benefits from it, you start recording it as part of your assets. You are now getting the economic benefits from it. Then now let's move on and talk about, so the list is not, it's not including all the concepts. Some of them will talk about it. Now let's move on and talk about the IFRS Foundation. So we have this board called the IFRS Foundation. We have this board called the IFRS Foundation. So this board is there to develop some of these concepts, some of these principles. So this board is there to ensure these principles, they remain in line with the current business environment. So they design standards so that that is the standards that can fit into the current business environment. So this board has branches that oversee the setting and regulation of accounting standards. So they have different branches we are going to talk about. So under the IFRS Foundation, we have the IASB. We have, let's list them, then we'll talk about each of them. So we have the IASB. Besides the IASB, we have IFRS Advisory Council. We have IFRS Advisory Council. Besides the IFRS Advisory Council, we have the IFRS Interpretations Committee. Let's add on one more. We have the IFRS Board of Trustees. So let's start with the IASB. Let's start with the IASB. This is the crucial board. So the IASB, they set the standards. They set the international accounting standards. So these ones we can say, these are concerned, these set the international accounting standard. So these ones are responsible for setting the international accounting standards. So the standards that we are going to be dealing with quite a lot in financial accounting, you hear of IAS, IAS 1, IAS 2, IAS 7, IAS 16. These accounting standards, they are designed by the IASB. Why do they design the international accounting standards? The purpose of these standards, the standards are designed to harmonize the accounting reporting system. Because now of international trade, because of companies now having branches in different parts of the world, we need one universal way of recording. So you can't have each country recording their accounts in a different manner. Of course, the country can choose to use their local standards. But if we have all adopted the international accounting standards, it means the way we are going to record the transactions, we are all going to record them in the similar manner. So the IASB is then the board that sets those international accounting standards. So the IASB, their boss or the one that oversees the IASB is the board of trustees. So these ones, they oversee the standard setting board. So they are the seniors. They don't create the standards, but they oversee the standard setting process. Sorry for that. Can I? Okay, so they oversee the standard setting board. Then we have the IASB. So the IASB, they are there to set the international accounting standards. They set these standards that we are going to be using all over the world. What then is the role of the advisory council? So the IFRIS advisory council, it works after the standards have been set. So they give advice to the IASB on standards that might be challenging to use in some parts of the world, or on challenges which are being faced in applying the standards that they have set. So these ones, they advise the IASB on the standards they have set. And the areas which may need improvement. They advise on the areas where improvement is needed. So yes, the standards have been set, but maybe they are applicable in some parts of the world. But other areas, other countries, they are failing to apply these standards. So then the advisory council comes into play, giving advice. It comes into play giving advice to the IFRIS Foundation on where there is need for an improvement. Then we have the Interpretations Committee. The Interpretations Committee, the IFRIS Interpretations Committee. This committee, the IFRIS Interpretations Committee, is there to assist those that might be facing challenges in understanding the standards. So the standard is there, but people might face challenges in understanding how can we apply the standard? What is the standard saying? So they help in interpreting the standards. That's giving more information about how to apply the standards. What is the standard saying? So that's interpretation of the standard. How should we apply this standard in our particular business case? Then, so that's the IFRIS Foundation. Then now let's move on and also talk about the next area, corporate governance. Corporate governance. This is also there in business and technology. We have corporate governance. So when we start the organization, we must create a corporate governance system. What is the corporate governance? This is the system by which organizations are going to be run, the system by which organizations are going to be controlled. So the corporate governance system, we can say by definition, this is the system used to run and control the organization. This is the system we are going to use or used by seniors of the organization to run and control the organization. So the seniors of the organization, they are going to design a system we are going to follow. The system can either be a good system, it can be a poor system. So we can either have a good governance or a poor governance system. You can tell this by how the business is operating. So if there is good governance, what are the elements of good governance? Good governance, you are likely going to see the business achieving its targets. Good governance, you are going to see things being done on time. Good governance, the stakeholders are going to be happy with the business. But poor governance, it means things are not being done the proper way. So if the organization has a good governance system, let's have some of the elements of good governance. So what are some of the key elements of a good governance system? In a good governance system, there must be a board of directors. The board of directors that tell us how we are supposed to do things in the organization. So if there is a good governance, there must be a board of directors. The board is the one that is going to be responsible for giving us the direction as the organization. They are going to tell us how we are supposed to do things in that organization. Then besides the presence of the board, there must be so besides the presence of the board, there must be committees, such as we have the audit committee, responsible for checking whether things are going well, the controls of the business are working well, ensuring that risks are identified in time. We have the remuneration committee that decides on the pay of the executive directors. There must be communication with the shareholders. There must be communication with the shareholders. If there's a good governance system, we should be communicating with the shareholders. The company is not ours. The company belongs to the shareholders. We should keep an open communication with the shareholders, telling them how the business is performing. Then, besides that, there must be transparency and accountability. There must be transparency and accountability. In an organization with a good governance system, we should be able to know how things are being done and who is accounted or who is accountable. When things go wrong, who do we ask? That's accountability. When things go wrong, who do we ask? The system must enable accountability. Okay, so those are some of the elements of a good governance system. Before we look at questions, let me just summarize with something that I believe you all know. So as we conduct the business, we also have the type of businesses. This is also there in business and technology, so we just quickly browse through this. So the types of businesses. So the business can be a sole trader. So if the business is being run as a sole trader business, it means there is one person in control. If the business is being run as a sole trader, there is centralization of power. Normally, the owner is the one running the business. So the business is being controlled by one person. This one person can either inject money or withdraw money from the business at any time. So a sole trader is not regarded as a separate business. It doesn't have, so this one, it does not have, it's not a separate legal entity. It's not a separate legal entity. The owner and the business are not separate. And due to that, in the event that there is debt, the owner suffers unlimited liability. The property of the owner can be attached in the event that there is debt. So there is unlimited liability. There is unlimited liability. In the event of debt, the property can be attached. Then we also have a business called the partnership business. So for the partnership business, this is formed by 2 to 20 people with a view of making a profit. So this one is controlled by a group. So by 2 to 20 people. That's an ordinary partnership. There can be different types of partnership. So it's 2 to 20. With the aim of making a profit. These are profit-oriented businesses. Then there is sharing of responsibilities, even losses, responsibilities. We share profits, we share everything. As partnerships, we share responsibilities. So you can say there is joint control over the business. So if it's a partnership, we share responsibilities. There's joint control. Then besides that, also it's worth noting that these partners are equally liable. So we'll not get into detail of this. We'll talk about it in business and technology. These partners are equally liable. So the liability doesn't depend on your share in the partnership. These are equally liable to the debts. And again, they have unlimited liability. Like the sole traders, these also have unlimited liability. They have unlimited liability. Then lastly for the day, let's talk about the company. So can prepare the accounts of the sole trader, a partnership, or a company. So if it is a company, this is formed by shareholders. Who leave the business in the hands of directors. So it's the shareholders that are going to start the company, but they won't run the company. They leave it in the hands of directors. It is then the directors that are going to run the company on their behalf. And a company is now a separate legal entity. This one, it is a separate legal entity. Your personal debts do not affect the company. Neither do the company's debts affect your personal property. There is a distinction. There's a gap there between the company and you. So you will not be affected directly by the debts of the company, unless if you're a director and it's a case where you try to use the separate legal entity cover to commit fraud or illegal dealings. So if we, for example, you get money in the name of the company, you use it for private benefit, then when the money has to be paid back, now we say, no, it's not my fault. Ask the company, not me. If you're the one that used that and that loan, even if it was used by the company, but if it wasn't in the best interest of the company, you might be personally liable. Okay, now with that in mind, let's go and look at I want us to look at some of the questions on this area. Now let's go to our kit and check questions on this area so that we confirm whether what we have been doing indeed is something that is capable of being asked. Just a moment here. So let's scroll up. Okay, so these are the questions. So you can even see number 2, number 3, we have discussed about that. Even number 1. Let's start at number 1. What do you think? What's the correct answer for number 1? Please, let's now all participate. What's the answer for number 1? Which of the following statements are true? I'm waiting for your answers. C, partners are liable for the losses in a partnership in proportion to their profit sharing ratios. Is that true? I said they are equally liable. So that one, no. You need a second try?
Fair, can I try? I think it's D. A company is run by directors on behalf of its members.
Yes, a company, we said, is started by shareholders. They leave it in the hands of directors. So a company is run by directors on behalf of the shareholders. Now let's move on to number 2. Statement of financial position. Which one best defines the statement of financial position?
I think it's D. It is a summary of assets and expenses at a specified date.
Statement of financial position. No, it's not D. Statement of financial position. That's the balance sheet. What does it look like? So the statement of financial position is a summary of assets, liabilities, and equity. So the statement of financial position, in the statement of financial position, we'll be recording the assets and liabilities of the business. Statement of financial position, it records the assets and the liabilities of the business. Then let's move on. Let's move on. Number 3. Let's try number 3. Let's try number 3. Let's quickly do that, please.
I think it's D. Say it is a summary of income and expenditure for an accounting period.
The summary of income and expenditure. Yes, that's correct. So the statement of profit and loss is the summary of incomes and expenses for the particular period. Let's move on. Number 4, which of the following users do you think would require most detailed information? The users, remember I gave you the list of the users of accounting information. Who would require detailed information? And can you give us why? A reason why?
Can I try, say?
Yes, you can.
I think it's the management, because usually the management is responsible for decision making and also like in terms of planning on how the organization will be making profit or maybe even the sales, the budgets and so on. They will require the detailed information for them to make informed decision.
Yes, it's the management, because the management, they make the key decisions for the business. So They actually make use of financial information and management accounting information. So they require detail from that list. So I think we have talked about the, let's move to another area, which we also talked about. Oh, number 8. I think we also discussed on number 8. What can you say about number 8? Let's be fast. Which of the following statements best defines a liability? Shouldn't take your time. Liability. Take note of best defines. Come again, Dorcas. You said what? C. A liability is a present obligation of the entity to transfer economic resources as a result of past events. Yes, that's the best definition. Of course, all the other definitions are also defining a liability, but they are missing out other issues. So C, I think from the list, C best defines. What about number 9? We also did talk about an expense. So I'm just showing you that some of the things we're discussing, you can actually be asked to those issues. Which one best defines an expense?
Okay.
An expense is the decrease in asset or increase in liability that results in a decrease in equity. Yes, that is correct. Number 10, we also talked about number 10, partnership. Which of the following statement is true regarding a partnership? Let's be fast, guys.
On my end, I think it's this partnership is able to own property and other assets in its own name.
Are you sure it's the best answer? I'm not taking...
Maybe B as well. B.
Yes, let's go for B. A partnership is jointly owned and managed by the partners. Remember, we said it's not a separate legal entity. So the moment we can say in its own name, we are looking at it now as if it's now a separate legal entity. I think let me just move down to the other issues we also discussed. But even such like definition of an asset, we did talk about that. Equity, we did talk about that, but let's move down. 23, the IFRIS Foundation. Which of the following items is the IFRIS Advisory Council responsible for? They give advice to who?
I think say it's for both 1 and 2, since IASB is the main body which is responsible for making the regulations.
Is responsible for what?
For setting like the accounting standards.
What's the role for the advisory council? Hello. So the advisory council, we say the advisory council is there to give advice. So they give advice to the IASB. So they give advice to the IASB. So that's their role. So they give advice to IASB on the decision. So let's go for 2. The trustees, they oversee the IASB.
Say, asaka hapo anza ichi hapo se. Kataba pe IASB.
I'm going back to that question. So now that they give advice to IASB on agenda decisions, that's C.
Okay, Saga, that's 2 only. All right, okay.
Okay, there's number 26. Which board is responsible for the issue of international financial reporting standard?
The answer is C, the International Accounting Standards Board.
The International Accounting Standards Board, yes, that's true. So let's close with this. The characteristics of useful financial information. So comparability, is it fundamental? Is it enhancing? Which one should we tick for comparability?
Enhancing.
Enhancing. Timeliness?
Enhancing.
Enhancing. Faithful representation?
Fundamental.
Fundamental. Understandability?
Enhancing.
Enhancing. Okay, so for today, let's end here. Then let's resume from there in the next session that's on Tuesday. So thank you so much for your time. Hopefully you understood. Please make sure you go and polish up the areas that might be lagging.